Welcome to this technical deep dive into Bittensor subnet valuation methodologies. Today's analysis will focus on quantitative frameworks, mathematical models, and data-driven approaches to understanding subnet alpha token economics. For those familiar with traditional asset pricing models, we'll be adapting concepts from the Farmer French factor models, Black-Scholes derivatives pricing, and network valuation theory to the unique characteristics of decentralized AI infrastructure tokens. The complexity of subnet valuation stems from their hybrid nature. They exhibit properties of utility tokens, governance tokens, and revenue-sharing instruments simultaneously. Our analytical framework must account for computational economics, network effects, and the stochastic nature of validator consensus mechanisms. We'll construct a multi-factor model incorporating subnet performance metrics, network utility functions, and token velocity coefficients. The mathematical rigor applied here will provide institutional-grade analysis suitable for portfolio optimization and risk management. Let's begin with a formal comparison of monetary policy mechanisms. Bitcoin operates under a deterministic emission schedule following the equation ST SHAO 21,000,001 EA/RT, where R represents the halving coefficient approximately equal to 0.1386 per cycle. Subnet token emissions follow a merit-based allocation function EST via SWI PUI to BT, where WI represents validator weights, PUIT is the performance score for subnet I at time t, and BT is the base emission rate. This creates a dynamic supply mechanism responsive to network utility. The fundamental difference lies in their respective utility functions. Bitcoin's utility can be modeled as UBTC, RODF, scarcity, network effects, monetary premium, while subnet tokens follow USubnet, G computational utility, network demand, validator, hold consensus, competitive positioning. From a tokenomics perspective, Bitcoin exhibits pure monetary characteristics with value accrual through stock-to-flow dynamics. Subnet tokens demonstrate service utility characteristics where value accrual occurs through network revenue capture and performance-based token distribution. The staking mechanism introduces additional complexity through delegation dynamics. The optimal staking strategy for subnet tokens involves solving max SURI, WI, CWI, where RI represents expected returns from subnet EI, WI is the weight allocation, and CWWI is the cost function, including opportunity costs and delegation risks. Network security models also differ significantly. Bitcoin security is proportional to hash rate and energy expenditure, while subnet security depends on validator stake distribution and consensus mechanism integrity. This creates different risk profiles requiring distinct analytical approaches. Our primary valuation framework employs a modified Gordon growth model adapted for network tokens. V founds R1 plus G1, odd out G, where R1 represents first-year network revenues, G1 is the growth premium, R is the required rate of return, and G is the sustainable growth rate. The network value to transactions model requires calculating NVT halve network DAO with value, daily transaction volume, but we must adjust for computational transactions rather than financial ones. Our modified formula becomes NVTAI market cap, daily inference count, average transaction value. For revenue generating subnets, we apply a discounted cash flow approach. PV or CFT is 1 plus R or T, where CFT represents the expected cash flows from network fees, adjusted for token holder distribution mechanisms and protocol revenue sharing. The Metcalfe's law application requires careful user definition. Our model uses V0K and A, where N represents active network participants and A varies between 1.5 to 2.0 depending on network type. Token velocity analysis employs the equation V equals GDP, M, where GDP represents network economic activity and M is the token supply. High velocity indicates utility, but may suppress price appreciation. Optimal velocity for value accrual typically ranges between 3 and 7 for utility tokens. The competitive positioning model uses a multi-factor scoring system. Score, sporty or weight, Y, metric, Y, incorporating technical performance, adoption metrics, team quality, and market positioning. This creates a relative valuation framework across the subnet ecosystem. Annual percentage yield calculation for subnet tokens requires adjusting for several factors. APY adjusted, NOI for 1 plus RN, N. 1. Inflation, rate, dilution, rate, where R is the nominal rate, N is the compounding frequency, and dilution accounts for token emissions. The risk-adjusted return analysis employs the Sharpe ratio, return risk-free rate, standard deviation. For subnet tokens, we must incorporate additional risk factors, including validator slashing risks, network performance volatility, and regulatory uncertainty. Optimal portfolio allocation following modern portfolio theory requires calculating the efficient frontier, MENWSW subject to WM, MP, and W1, SHA1. Where W represents portfolio weights, S is the covariance matrix, and M represents expected returns. Duration risk for locked staking positions follows. Modified duration, stack DPP, show DY, where P is the token price and Y is the yield. Longer lockup periods increase duration risk, but may offer higher yields to compensate. The Kelly criterion application for position sizing, F now whole, BP, whole Q, whole B, where B is the odds, P is the probability of success, and Q is the probability of failure. For subnet tokens, this helps determine optimal allocation sizes given expected returns and risk parameters. Current market analysis reveals significant pricing inefficiencies using standard statistical measures. Our correlation analysis shows R2 values below 0.3 between subnet performance metrics and token prices, indicating substantial mispricing. Volatility analysis using Garch models demonstrates that subnet tokens exhibit higher volatility clustering than traditional cryptocurrencies, with average daily volatility ranging from 8 to 15% compared to Bitcoin's 4 to 6%. Regression analysis on network fundamentals reveals that current prices explain only 23% of variance in performance metrics. R2 new 0.23, suggesting significant opportunities for fundamental analysis-based strategies. The market cap to network revenue ratios show extreme variation, ranging from 50x to 500x, compared to traditional SaaS companies trading at 10-20x revenue multiples. This indicates either massive overvaluation or expectations of exponential growth. Statistical arbitrage opportunities exist between subnet tokens with similar functionality but different market capitalizations. Our pairs trading model identifies potential mean reversion opportunities with expected Sharpe ratios of 1.2, 1.8. Monte Carlo simulations modeling various growth scenarios suggest that current valuations require sustained 100% plus annual growth rates to justify present prices, which appears statistically unlikely based on historical network adoption patterns. Our technical analysis framework provides institutional-grade tools for subnet token valuation. Key mathematical models include the modified Gordon growth model, adjusted NVT ratios, and multi-factor scoring systems. The primary conclusion is that current market prices demonstrate significant deviation from fundamental value, with correlation coefficients below 0.3 between price and performance metrics. This creates opportunities for quantitative strategies. Risk management requires careful attention to duration risk, validator slashing probabilities, and token velocity dynamics. Optimal portfolio allocation should incorporate these factors using modern portfolio theory frameworks. For comprehensive quantitative analysis and additional mathematical models, I recommend reviewing the Unsupervised Capital research linked in the description. Their statistical analysis complements our technical framework with additional empirical data. Future research should focus on developing more sophisticated models incorporating machine learning techniques for subnet performance prediction and automated valuation updates. Thank you for your attention to this technical analysis.